Yes.
Started? Yeah. Good afternoon. My name's Sam Foley with Legg Mason. Blair gave me 2 minutes and exactly 2 minutes to talk to you guys this afternoon, so I'm going to get down and dirty and talk about growth, specifically the ClearBridge Large Cap Growth Fund. Before I get into this fund specifically, I just want to let you guys know how ClearBridge breaks down their different strategies. They actually break it into 3 buckets. The first being income solutions, the second being concentrated alpha, and the third being low volatility strategies. Today we're going to talk about the concentrated alpha, where the ClearBridge Large Cap Growth Fund resides amongst its other growth strategies. So I was sitting down with Peter Bourbeau. He's the lead portfolio manager on the ClearBridge Large Cap Fund, and he actually takes it a step further and breaks down the fund into 3 separate buckets. Go figure. First, you have the cyclical growth names, a name like Caterpillar. Then you have stable growth names, like Visa. Then you also have select growth. And when I first was chatting with Peter, I actually didn't know what select growth was. It's something he kind of came up with. Basically, these are companies that are increasing their top line revenue at around 20% or so. Now, I know you guys are a savvy bunch, and you know, large cap growth names, they typically don't have their top line revenue increasing at that kind of pace. There are those opportunities out there, and we are actually looking to capitalize on them. One of the names being Biogen, which was actually a small cap company in 1992. So just real quick to recap, low turnover portfolio ranging from 20 to 40%. Category King was ranked number 8 out of 776 other large cap portfolios. High active share ranging from 70 to 75%. High conviction, high portfolio. So I'm going to open up to any questions from the group.
Sam,
yeah.
Sam, got a quick question for you. I've been reading that there's a lot of outflows coming out of growth. Why should I allocate money to the space?
That's a great question, and there has been a lot of money leaving the growth space. But essentially, there's 2 problems facing investors today. One on the fixed income side, which is, how do I deal with rising rates? And Vicky and Lucas, that's their problem. And then on the equity side, it's, if the S&P is only providing single-digit returns, what are clients going to do for excess returns? They're going to hire growth managers who are looking to provide that excess growth over single-digit returns, which is what this portfolio would, hopes to accomplish.
Actually, Sam, to your point about the higher growth rates, this fund being category has done extraordinarily well. Some people would argue the market may be overvalued. How do you mitigate risk?
Well, we would actually say that the market is not overvalued. Right now, I believe it's trading at 17 times earnings, probably less than that with the pullback today. If you use the rule of 20, where you take 20, then minus the CPI, you come up with a multiple. I think it's in the high 18s right now. And basically what you do is, that's where the market should be fairly valued. So there's still a room to the upside. If you aren't a bull, a stock market bull, you can still be a bull in like the growth names.
Sam, thanks for coming. I got to tell you, a lot of my large cap growth managers will come in, they'll talk to you, us kind of like you did, but you look underneath the hood and it's Apple, Amazon, Google. How do you guys screen the stocks? What are you guys utilizing to actually pick the stocks, and how are you differentiating from the competition?
Sure. So full disclosure, we do have those 3 securities in the fund, but if you look at the different growth buckets that Peter uses, so cyclical growth names like Caterpillar I mentioned before, heavy construction company. Now that's going to do well when metals and mining, stocks were rising, which we just kind of saw the end of that just happen. So that's something that we're kind of at the peak of the business. So if it fits into one of these 3 buckets, right? So names will move in and out of the cyclical growth bucket. That's kind of how we screen that 25% portion. Then for the 50% portion, these are the stable growth names. Most of the names you'll see. These are high barrier to entry companies, the ones with the big moats, like Visa. Visa's only competition is MasterCard and cash, right? So that's a high barrier to entry business, right? Amex is a charge card, not a credit card, so not in the same business. And then the select growth company. Now, if you look at select growth, I mentioned that 20% revenue top line growth. Once that changes, let's say it goes down to 15, Peter will reevaluate and say, hey, is this a cyclical growth name now? Or is it a stable growth name? And if it's neither, he'll sell it. So that's kind of our buy and sell discipline for screening out other names.
Okay, thanks.
Any other questions?